Hello everyone, welcome to EduTap and welcome to today's very important session. So the IMF, that is the International Monetary Fund, has released the Financial System Stability Report. The IMF has released the FSSA, that is the Financial System Stability Assessment Report for the India. Okay, so this is a very important report that the RBI has released the press release about. So RBI has released the press release about the IMF that has released the Financial System Stability Assessment Report of India. So this report is very, very important as it is talking about the whole of the financial system of our country, that we are going to discuss that what IMF has said about the financial system of our country. And let me tell you that the Reserve Bank of India and the India has welcomed the assessment. So we will discuss that what are the good points that the IMF has mentioned and what are the recommendations that the IMF has provided for the financial system of our country. Okay, so India's financial system resilient, diverse, IMF has reported. IMF has also provided many of the recommendation, and this has been mentioned in the RBI press release. So this report or this press release becomes very, very important, that you can understand. Okay, so good morning to all of you, and in today's session we are going to discuss this very important report of the IMF from the RBI's press release perspective. Okay, as the RBI has released the press release about it. So let's get started. And remember that from this particular topic, a descriptive question can also come and an objective question can also come. So we will discuss about the program of the World Bank and the IMF, and then we will discuss in depth the recommendations and the report of the IMF. So let's get started. But before that, do subscribe to the YouTube channel of EduTap so that you continue getting these relevant videos, and do join our Telegram channel. In the Telegram channel, you will be getting the PDF of the session, and the link for the Telegram channel is provided in the description box below. And I hope I am clearly audible and visible. So we are going to discuss a very important report of the IMF. We are going to discuss a very important press release of the Reserve Bank of India. So RBI has released the press release on March 24th, 2025 regarding the India Financial Sector Assessment Program 2024. So the Financial Sector Assessment Program, this is a joint program of the International Monetary Fund and the World Bank. They undertake a comprehensive and in-depth analysis of a country's financial sector. So there is a comprehensive and in-depth analysis that happens of the financial sector of a country, that is the banking sector, involving the banking sector, the insurance sector, the securities market, and the NBFCs. So you can understand that the whole of the financial sector of the country, it is analyzed by the IMF and the World Bank, and the IMF and the World Bank, they provide a comprehensive and in-depth analysis of a country's financial sector, that what are the improvement areas, what are the areas in which the financial sector can further work. Okay, so this is a joint program of the IMF and the World Bank. Both of these organizations are very, very important, and the reports from these organizations have been directly seen in your descriptive part of the RBI examination and the NABARD examination. Okay, so now what has happened? So this is the Financial Sector Assessment Program, that is a joint program of these two international institutions. Since September 2010, the exercise has become the exercise of doing the analysis of financial sector. This has become mandatory for jurisdictions with systemically important financial sectors. How many of you have heard about systemically important banks, the domestic systemically important banks? I hope many of you have heard that State Bank of India, ICICI Bank, SDFC Bank, they are the domestically systemically important banks in our country. They are the banks that are too big to fail. They are the too big to fail banks. Similarly, at the global level, there are the financial systems that are too big to fail. There are the financial systems that are too big to fail. That means if any problem is coming in the financial sector of a particular country, that is a very important financial sector that is interlinked with the other financial systems of the other countries. So that financial system is too big to fail. Okay, so at the global level, there are the systemically important financial sectors that are the important financial sectors that are too big to fail. If any problem come in these financial sectors, it can affect the global economy, it can affect the global financial system. Okay, so the systemically important financial sectors, these are the too big to fail financial systems and the financial sectors. Okay, so since September 2010, the exercise has become mandatory to analyze the financial sector of the different countries, that are the jurisdictions, that are the countries with systemically important financial sectors. Currently, it is mandatory for 32 jurisdictions, for 32 countries, including India. So India is also under the systemically important financial sector. That means India also has a financial sector that is too big to fail. That means if any problem comes in the financial sector of India, that can affect the global economy, that can affect the global financial system. So India also has a systemically important financial sector. So currently it is mandatory for 32 jurisdictions, including India. Every 5 years, this analysis happens. This financial sector analysis happens, and for another 15 jurisdictions, in every 10 years, this analysis of the financial sector happens. So you can understand that India has one of the systemically important financial sectors, and for India, every 5 years, there is the analysis that is done for the country's financial sector. That is it healthy? What are the reforms that have been undertaken? What are the reforms that can be taken in the future? So last financial sector assessment program, the financial sector assessment program for India was last conducted in 2017, and the financial system stability assessment report, this was published by the IMF on 21st December 2017. Okay. So this is the idea that financial system or financial sector assessment program, this is the program under which IMF and the World Bank, they analyze the financial sector of a country. Okay. Now under the financial sector assessment program, once the assessment has happened, so the financial system stability report is released. So it is released by IMF. Okay. This is released by the IMF. Now this was the financial sector assessment program for India last happened in 2017, and the financial system stability report was last released by IMF in 2017 on 21st December 2017. Okay. Now IMF has released the latest India financial system stability assessment report. So IMF has released the latest India financial system stability assessment report on their website on February 28, 2025. Based on the assessment that is carried out during the 2024, this is the financial system stability assessment report that is released by the IMF. So IMF, on the basis of the assessment that has happened in 2024, so on the basis of assessment or on the basis of the analysis that the IMF and World Bank has done in 2024 for the financial sector of India, the IMF has released the financial system stability assessment report on February 28, 2025, while World Bank's financial sector assessment report is due for publication. So this is the idea. So IMF has released the financial system stability assessment report, and this has been mentioned, or this has been included in the RBI's press release. Now India welcomes the assessment of the Indian financial system undertaken by the joint IMF and World Bank team, conforming to the highest international standards. So they have confirmed that India is moving towards the highest international standards, and India in many cases has started to do to have the highest international standards. Okay, so India welcomes the assessment that is done by the IMF and World Bank in the joint form, and this is the assessment of the Indian financial system conforming to the highest international standards. So IMF's, the International Monetary Fund, has issued the financial system stability assessment report, highlighting that India's financial system has become more resilient and diverse since the last financial system assessment program in 2017, driven by rapid economic growth that has happened. So this is the India financial sector assessment program. So this has been recently happened in 2024, and the financial system stability assessment report has been released by the IMF on February 28, 2025, in which it has been said that India's financial system has withstood the pandemic well and has become more resilient since the 2017, since the last financial sector assessment program. Okay. Now, financial sector in India has shown recovery from various distress episodes in 2010s. So in the 2010s, in the period of 2010, there was a lot of distress problems that were coming in the financial sector of our country. During the 2010, India's financial sector faced several crises. There was stressed corporate balance sheet. The balance sheet of many of the banks, many of the NBFCs was very much stressed. There were heavy losses that were happening. The NPAs, non-performing assets, were very, very high in the banks, particularly the public sector undertaking banks. So there was stressed corporate balance sheet, and the high NPAs that were faced by the banking segment, that was specifically faced by the public sector undertaking banks. So the default by LFS in 2018. This led to a liquidity crisis in the NBFC sector. So in the ILNFS, there was a default situation that happened. So ILNFS, this was a core investment company that used to invest in different institutions. Now it started to default. The loan, like, it was not able to complete its obligations, or it was not able to fulfill its obligations. So the default started from the ILFS, and a liquidity crisis started from there in the NBFC sector, because ILNFS was a very big institution, and as the default was done by the ILNFS, there was a liquidity crisis that started in the NBFC sector. So in the 2010s, there was a lot of stress situation that was coming for India. High NPAs were there in the banking sector. In the NBFC sector, there was liquidity crisis that started from the ILNFS situation. So many problems were coming in the 2010s, but it has been said that the financial sector in India has shown recovery from the various distress episodes of the 2010s and withstood the pandemic well. That means we have handled the pandemic very well. So in terms of evolution that has happened of the financial sector landscape, the non-banking financial intermediaries. So non-bank financial intermediaries, the non-bank financial intermediaries, you can understand that all the non-bank, all the institutions that are not the banks, but they are under the financial intermediaries, they are in the financial sector. So they are the non-bank financial intermediaries, such as your NBFCs, non-banking financial companies, your mutual funds, the pension fund, the insurance companies. So these are the non-bank financial intermediaries. These are the non-bank financial intermediaries. These are not banks, but they are in the financial segment. They are in the financial sector. So these are the non-bank financial intermediaries. So it is said that all these, so in terms of evolution of the financial sector landscape, non-bank financial intermediary sector has become more diverse. They have become more diverse, but more interconnected also. So there is more and more entities that are popping up. Non-bank financial intermediaries means the mutual funds, the insurance companies, the pension fund, as well as the fintech platforms, the digital lending platforms. So there are more and more diverse nature of non-banking financial intermediaries that are coming up, but they are becoming more interconnected. Okay. So in the category of non-bank financial institutions, especially non-bank financial companies. So in the non-bank financial institutions, especially the NBFCs, there are various different kinds of NBFCs that are present. NBFC factor, NBFC account aggregator, NBFC core investment companies, NBFC. So there are multiple kinds of NBFCs that are present in the domain. Okay. So non-bank financial institutions, especially the non-bank financial companies, they are providing credit with wholesale financing and market financing. This has grown. So financing provided or the credit provided by the NBFCs has grown, and they are becoming more diverse, making the financial system more diverse, and they are also becoming more interconnected. So the non-bank financial intermediaries, there are various institutions in the non-bank financial platform. Like the mutual fund, pension fund, digital lending platforms, and your fintech platforms and such. So they have become more diversified, they have become more diverse, but more interconnected also. So banks and NBFCs, they have sufficient aggregate capital, they have sufficient capital with themselves to support the moderate lending even in severe macro financial scenarios. So even if there is a severe macro financial scenario that initiate, there is a severe crisis that comes. So if there is a moderate severe crisis that come in our country, so even in that case, the banks and the NBFCs, they will be able to support the moderate lending. So in case of severe macro financial scenario, in that case also, there can be the moderate lending that can continue from the banks and the NBFCs. So that shows that banks and the NBFCs, they have sufficient capital, first of all, to handle the macro financial crisis in the country, as well as to continue lending even in that kind of severe situation. So that shows that India has enough of the capital buffers in the banks and the NBFCs. On regulation and supervision of the NBFCs, the IMF acknowledged India's systematic approach, in which the India or the Reserve Bank of India has brought the scale-based regulatory framework, in which the NBFCs are divided into 4 layers. So NBFCs are divided into the NBFC base layer, middle layer, upper layer, and top layer, and as per the difference in the layers, the different norms, regulatory norms that are followed. Okay. So on regulation and supervision of NBFCs, the IMF has acknowledged India's systematic approach for prudential requirements for prudential regulations of NBFCs with scale-based regulatory framework that helps RBI to gauge the risk category of the NBFCs and put the important regulations, put the required regulations on the basis of the risk, okay, in the NBFCs. IMF has appreciated India's approach to introduce the bank-like liquidity coverage ratio in terms of large NBFCs. Now, what is the liquidity coverage ratio? This we have discussed in the previous sessions also. Liquidity coverage ratio is the high quality liquidity assets, liquid assets that are available against the net cash outflows in the coming 30 days. Okay, so the banks have to maintain the liquidity coverage ratio of 100%. That means against the net cash outflow, the outflow of the cash that can happen in the next 30 days. So let's say 1000 crores of the cash, 1000 crores of the cash outflow can happen in the next 30 days. So the banks have to maintain the high quality liquid assets. That is, the banks have to maintain the cash or the government securities or the other assets that are quite liquid, at least up to this, so to cover this kind of cash outflow. Okay, so the banks, they have to calculate the net cash outflow for the next 30 days and they have to maintain the high quality liquid asset to cover the net cash outflow. So that is liquidity coverage ratio. Liquidity coverage ratio shows, recently the data for the IndusInd Bank was released by the Reserve Bank of India. So RBI told that IndusInd Bank has the liquidity coverage ratio of 113%. That means against the net cash outflow for the next 30 days, let's say the net cash outflow in the next 30 days is going to be 100 rupees. So against that, the bank was having the high quality liquid assets of 113 rupees that will be easily able to cover up the cash outflow that is going to happen from the bank in the next 30 days. Okay, so that the depositors, if they are coming to ask for their money, the bank can easily provide the money, the bank can easily do the cash outflow when required. Okay, so the net cash outflow for next 30 days, against that the high quality liquid assets have to be maintained so that the cash outflow can happen in the easy manner. Okay, now this bank like LCR, this has been introduced for the large NBFCs also, so that the large NBFCs, they are also able to take care of the outflows. They are also able to take care of the cash outflows that are required to be done by the large NBFCs. Till now, any confusion, anyone? Any confusion in this? So for on regulation and supervision of NBFCs, the IMF has acknowledged the prudent regulations that the RBI has brought for the NBFCs in terms of scale-based regulatory framework, and the IMF has appreciated that the RBI has made the large NBFCs to also follow the LCR just like the bank. Okay, coming to the next point, for supervision of banks, IMF has suggested strengthening the credit risk management through the IFSR 9 adoption. So the IMF has said that for supervision of banks, there is the recommendation that is provided by IMF, that IMF suggested strengthening the credit risk management. The credit risk management should become stronger. How it can become stronger? So till now, what happens that in India, the accounts are maintained in such a manner that we see the incurred loss model. We follow the incurred loss model. That means loss is recognized when the default has actually happened, or when there is the data, or when there is the fact that has been provided that the default has happened. So once the loss has been incurred, then it will be recorded, then it will be recognized. So in the incurred loss model, the loss is recognized once the default has actually happened. Okay, but in case of expected credit loss model, in this there is a proactive method that is used, and it is seen, the loss is seen and the loss is recognized on the basis of the expected future default that can happen. Expected future default that can happen. Okay, so incurred loss model that we currently follow, in this, loss is only recognized once the default has actually happened. So the bank will only recognize the default once it has actually happened. So this is a very reactive approach where the bank is only thinking about the loss, or bank is only recording the loss once the default has actually happened. So in this case, the bank is not able to take the measures beforehand. The bank will take measures, and the bank will take measures only after the loss has been recognized, the default has actually happened. While in the case of expected credit loss model, in this case, the loss is recognized on the basis of expected future default that can happen. So beforehand, the bank can start putting some measures, and bank can start putting some provisions to handle the loss that can come in the future. So let's say that automobile industry is facing the problem. Now the bank has recognized that the automobile industry, the profits are decreasing. Many of the companies have started to make losses. So that means there is the expectation of the future default, that any one of the small automobile company can make a default in the future. So on the basis of the expected credit loss, the provisions, the banks will start to take the provisions, the bank will start to take the measures. So currently if we follow the incurred loss model, that is the model that takes into account the loss only when the default has happened. So the banks have very less time to handle the situation. While in the expected credit loss model, it is the expected future defaults are seen, that okay, the economy's condition is bad, the many of the industries, they are not able to have profits, the industries, they are not able to sustain themselves. So yes, in the future the default can happen from this particular industry, so we should start maintaining the provisions. So International Financial Reporting Standard 9, this is a global accounting standard for financial instruments that replaces the traditional incurred loss model with an expected credit loss model. Okay, that the loss should be recognized on the basis of expected future defaults, so that on the basis of the loss that can happen in the future, from now onwards the banks have started to take the measures and the provisions. Okay, so this means banks must proactively recognize potential credit losses, the future credit losses that can happen, rather than waiting for the defaults to actually happen and then after that taking the measures. That is wrong. So currently we are following the incurred loss model, that is a traditional model, that is a model that has been followed till now, but this has become very reactive. That means bank only takes step once the default has actually happened. Instead, the IMF is saying that rather than following the incurred loss model, start following the International Financial Reporting Standard 9, that is a global accounting standard where expected credit loss model is followed. Okay, so IMF has suggested strengthening the credit risk management through IFSR 9 adoption and upgrading the supervision for individual loans. So if you have more supervision, if you are seeing the loans, like individual loans are given with prudent norms being followed, with prudent supervision, with good supervision, if the loans are being given, there are lesser chances for the non-performing asset, there are lesser chances for it to turn into non-performing asset. Okay, collateral valuation should be done in the proper manner, in the prudent manner. That means let's say gold is right now inflated. Right now, if the gold loan is given on the inflated value, by the time that the loan has to be repaid, let's say the loan is not getting repaid, and after 2 years you will recognize that okay, the gold value is not as you considered at the time of inflation. Okay, so collateral value, whenever the collateral value has been measured for the real estate, for the gold, for any other collateral, the collateral value or the collateral valuation should be done in a prudent manner and decreasing the inflation. Okay, so that you have the actual collateral value after deducting the inflation. Connected borrower groups. So the connected borrower groups, let's say in the Reliance Industries, there is Jio Financial, there is Reliance Telecom and such. So the connected borrower group, the prudent supervision should happen when the loans are given to the connected borrower group, because if one entity falls down, it affects all the other connected borrowers. Okay, so if one entity in a group is falling down, it affects all the other connected entities. So when the loans are given to the connected borrower groups, there should be prudent supervision that should happen. Large exposure limits have to be identified, that if to a single borrower, if a large loan is being given, so there should be the maximum exposure limits that has to be identified in a good manner. So large exposure limits have been identified by the RBI, but it is said that you have to review the large exposure limits so that there is not the concentration risk that is happening. Because let's say a bank has large exposure, let's say a bank has a very large exposure of 1,000 crores to a single entity, and this entity is falling down, so the whole of the bank will be affected. Whole of the bank will come into the distress kind of situation. So the concentration risk is very high when a single entity is provided with a large exposure, with a large loan. So large exposure loans have to be, large exposure limits have to be identified in a good manner. And related party transactions, let's say that the bank has many related entities, that this bank, it is connected with the entities. Let's say the bank has the promoters, let's say XYZ, ABC, and the DEF. So they are the promoters of the bank. That means they have established the bank. Now let's say they have some other businesses also. Now they require the loans for that business. So they can use the bank to get the easy loans without providing the full information to the bank. So you can understand that the related entities of the bank, the related entities of the NBFCs, they can misuse the banking structure, they can misuse the NBFCs if they are related to that bank or NBFC. Okay, so that has to be taken. Supervision has to be very strong in regards to the related party transactions. If a bank or the NBFC is giving the loan to a related party, so that has to be prudently managed and the supervision should be very much strong. Okay, so this is the idea. Now coming to the securities market. So we have discussed about the bank and NBFCs, the assessment on the banks and NBFCs. Now coming to the assessment on the securities market. Now remember that this assessment is provided in 5 years. So after this, like IMF has provided it in 2024, now the next one will be provided in the later on period after 5 years. So this assessment is very important. Okay, IMF acknowledges that the regulatory framework in securities market has been enhanced in line with the international practices to manage and prevent the emerging risk. So it has been recognized by the IMF that the regulatory framework for the securities market is quite strong and it has been as per the international practices. Notable improvements that has happened in the securities market include the corporate debt market development fund. So corporate debt market development fund has been set up. So this has been set up to act as a backstop facility, like in the government securities market there is primary, in the government securities market there are primary the entities, okay, that work as a market makers, they buy and sell the government securities to maintain the liquidity in the market. So in the government securities there is the primary entities, or what do we call it? I am not able to recall the name as per, if anyone can suggest. So they are the entities in the government securities market that work as a market maker, that help in the buying and selling of the government securities to maintain the liquidity in the government securities. So they buy the government securities when there are a lot of sellers of the government securities, and they sell the government securities when there are a lot of buyers of the government securities in the market. Okay, primary dealers, I guess. So now the corporate debt market development fund will work as the market maker, or this has been set up to act as a primary dealers. Yes. So corporate debt market development fund, this has been set up to act as a backstop facility for purchase of investment grade corporate debt securities to provide confidence on these securities when the participants are having the stress situation, when there is stress in the corporate debt market. So to provide the confidence to the buyers, to provide the confidence to the investors, to instill the confidence among the participants in the corporate debt market during time of stress, the corporate debt market development fund purchases the debt securities, purchases the investment grade corporate debt securities. Okay, and generally they enhance the secondary market liquidity by creating a permanent institutional framework for activation in times of market stress. So basically corporate debt market development fund, they provide the confidence to the market participants when there is any kind of stress that is coming. So let's say there is stress that is coming in the financial markets. So the corporate debt market development fund sells or buys, they usually buy the corporate, they usually buy, not sell, but they usually buy the corporate debt to instill the confidence on the market participants that the debt is not the problem, the corporate debt instruments are not the problem. Generally the stress is coming in a period of time that will be sidelined in the other period of time. Okay, so the corporate debt market development fund has been developed to instill the confidence on the investors when there is stress that is coming in the corporate debt market. The corporate debt market development fund purchases these corporate debt to instill the confidence, as well as they also maintain the liquidity in the secondary market. Okay, next is the regulatory scope has also been expanded over emerging areas. So there is the CDMDF fund that has been created, introducing the swing pricing. Swing pricing means that when there is stress that is coming in the mutual fund, so the NAV value is adjusted. the net asset value of the mutual fund is adjusted so that the long-term investors in the mutual fund, they are not getting harmed. Okay, so in the swing pricing case, a mechanism, this is a mechanism that discourages panic withdrawals during the time of stress in the mutual fund or during the time of the stress in the market, not the mutual fund, but let's say there is a stress that is coming in the market. Right now, the market is falling down. There is the market that is going down. So when there is the stress that is coming in the market, to discourage the panic withdrawals from the mutual fund, the NAV value is adjusted, the net asset value is adjusted, so that if you are redeeming the, if you are closing down the, let's say you are closing down your, you are taking away your money basically. So if you are taking away the money during the stress situation, you will be bearing more cost as compared to the investors that are keeping their money in the mutual fund for the long period of time. Okay, so this is the basic idea, that a mechanism, swing pricing is a mechanism that discourages the panic withdrawals during the stress situation from the debt mutual fund by adjusting the NAV based on redemption pressure. So NAV value is adjusted so that the investors that are exiting right now during the market stress, they bear a higher cost protecting the long-term investors in the mutual fund. Okay, so this is swing pricing. So swing pricing has been introduced and liquidity requirements for the bond mutual funds have been increased. So these measures have been taken so that the securities market, so that the whole of the financial market is working in a very smooth manner, or it should work in the smooth manner. The regulatory scope has been expanded over emerging areas. So regulatory scope has been expanded. Now in the sustainability area also, the listing companies, they have to report in terms of ESG norms also, environment, social and global, environment, social and they have to governance norms. So in terms of environment, social and governance norms, the listing companies, they have to report in these norms also, that what they are doing for the environment, how much they are spending for the sustainability, how much they are spending, or how their governance is. So ESG reporting norms for the listing companies have been introduced, and investor protection measures have been taken for the fast growing equity derivatives products like the options and the futures. Okay, so for these derivative market, the investor protection measures have been taken. No, it is only for the debt mutual funds. It is only for the debt mutual funds, because the debt, corporate debt, they are usually for a period of time, let's say 5 years, 10 years or such, okay, or 1 year or such. Corporate debt securities, well, like I will tell you it at the end of the session. This is a basic term that you need to know from the static point of view, but basically corporate debt security, this is a debt instrument. This is a debt instrument through which the corporates, that is the companies, they can raise the money from the investors. Okay, so they are usually for a time period. Okay, so this is the corporate debt security, that is, this is the debt instrument through which the corporates can raise the money from the investors. Okay, now IMF has stated that public digital infrastructure have significantly improved the retail financial inclusion. So public digital infrastructure such as your Aadhaar card enabled eKYC, electronic KYC that happens, or the public digital infrastructure such as your UPI, okay, or Aadhaar enabled the eKYC that happens. So the IMF has stated that the public digital infrastructure, they have significantly improved the retail financial inclusion, the UPI system, the KYC system through the Aadhaar card, and the IMF has recommended that financially underserved sectors like the rural businesses, the businesses in the rural areas, the informal sector, the MSMEs. So these are the sectors that are underserved, let's say. So in these sectors, there should be access to credit that should be enhanced by strengthening the legal, tax and informational infrastructure for asset-based and digital lending. For the collateral-based and the digital lending, there should be the enhancement that should happen. There should be strengthening that should happen for the legal, tax and informational infrastructure. Okay. Yes, DigiLocker also. The FSSA report, so the Financial Sector Stability Assessment Report, acknowledges that India's insurance sector is strong. So till now we have discussed about the securities market, till now we have discussed about the banks and the NBFCs. Any confusion till now? Now we are going to move forward with the insurance market. Any confusion? All clear? No confusion? Okay. So the ma'am, systemically important banks are the State Bank of India, ICICI Bank, HDFC Bank. Systemically important insurers are the LIC, GIC and the NAICL. NAICL. So these are the three entities. LIC, GIC and NAICL. So they are the systemically important insurers in our country. Got it? Okay. Systemically important insurance industry, it is systemically important insurers or systemically important insurance companies. They are LIC, GIC and NAICL. Okay. So let's continue now. Now coming to the insurance sector. So the financial sector stability assessment report acknowledges that India's insurance sector is strong and growing with a significant presence in both the life insurance segment and the general insurance segment. The sector has remained stable, supported by better regulations from the IRDI and the IRDI, the Insurance Regulatory and Development Authority of India. So IRDI has been continuously taking steps for the digital innovations. IRDI has introduced the Bima Trinity, that is Bima Sugam, Bima Vahak, Bima Vistar. So IRDI is taking steps for the digital innovations in the insurance sector domain. So this is a very good initiative by the IRDI. It is bringing better regulations and digital innovations in the insurance domain. The report notes, so the IMF report has noted that the India's progress in improving oversight. So IRDI has taken steps to improve oversight, to improve the oversight of the whole of the insurance sector. Risk management and governance is good and suggest. So IMF suggests that further steps has to be taken toward risk-based solvency. So right now what we follow is one size fits all. So how many of you know about the solvency margin of the insurance sector? Solvency ratio of the insurance sector. How many of you are aware about this? What is the solvency ratio of the insurance sector? Solvency ratio is 150%. That means against the liability of the insurance sector, the insurance sector has to maintain the assets of 150%. So let's say that LIC has the liability of 100, or let's say a XYZ insurance company has the liability of 100 crores. So against the liability of 100 crores, the company has to maintain the assets of 150 crores. So that is solvency ratio of 150%. Liability of an insurance company is that, let's say that you have given insurance for the health insurance you have given, or you have given the fire insurance. What if the fire actually happens? So there are some obligations that you will have to fulfill. There is some money that you will have to pay. So this is the liability for the insurance companies. That is your obligation that can that you might have to pay. Or so against the liability, against your obligations of 100 crores, you have to maintain the assets of 150 crores. That means solvency ratio is 150%. Okay, against your liability, you must have the assets worth 150, or it should be 150%. So this is the solvency ratio for all the insurance companies in the insurance sector. What if some insurance companies are more risky? What if some insurance companies are less risky? They all have to maintain the same solvency ratio. So right now, one size fit all. This is the policy that is being adopted, or this is the norm that is being adopted. So what is happening currently, that instead of one size fit all, IMF has said that we need to focus on the risk-based solvency ratio. That the insurance companies, if they are more risky, they should maintain more solvency ratio. If they are less risky, they should be allowed to maintain around the regulatory minimum. Okay, so this is the idea that the IMF has suggested further steps to a risk-based solvency. That is, the solvency ratio or the supervision frameworks should be on the basis of risk basis, not one size fit all. All the risky companies, or the risky insurance companies, or the normal non-risky insurance companies or less risky insurance companies, they all are following the same solvency ratio. So IMF has suggested that there should be risk-based solvency ratios, there should be risk-based supervision frameworks and stronger group supervision. That let's say that a single insurance company, it belongs to a larger financial group. Okay, let's say SBI there is a SBI insurance company. Let's take an example. So the SBI insurance company will be the part of the larger SBI group, or let's say ICICI Prudential, that is the insurance company. Okay, so ICICI Prudential insurance company, that is a part of larger ICICI bank group and such. So the stronger group supervision is required if a insurance company, it is a part of larger financial group. So the insurance company, on that the supervision should be stronger, because it might provide insurance for such banks that are in the related group. Okay. So the IMF suggests further step toward the risk-based solvency requirements and supervision based on the risk based. Okay, it acknowledges, the IMF acknowledges that the insurance company IRDI, if you have seen the recent IRDI annual report, IRDI has itself said that it is going to move towards the risk based, or it is thinking about moving towards the risk based solvency requirements and the risk based supervision framework. So IMF has acknowledged the transition plan towards risk-based approach in the insurance sector that the IRDI has already acknowledged about. IRDI has already said that we are thinking of moving towards the risk-based solvency requirements, the risk-based approach. Okay, this reflect the India's commitment to a global best practices and resilient insurance sector. So this is the idea that the IMF suggested that you have to take further steps towards the risk-based solvency requirements and the supervision frameworks, but the IRDI has already started, and the IMF has recognized this, that the IRDI, the Insurance Regulatory Development Authority of India, has already started taking steps or planning towards the risk-based approach. So IMF has recognized this commitment to global best practices and a resilient insurance sector. Now coming to the last part of the session, so IMF recommend that the financial stability should be the priority of the regulators. In terms of emerging risk, there are various risks that are emerging. Okay, cybersecurity is one of the major risks. Cybersecurity. You can understand that if the cybersecurity is not followed properly, there is data privacy or data leakage. If that will the problem of the data leakage can come if the cyber security is not strong. The phishing attacks, the frauds will become more prominent, and if the cyber security is not strong, our whole digital ecosystem will degrade. Okay, so cyber security, it is a very heavy risk that the RBI and the other regulators have to focus on. They have to focus more on cyber security, because the data privacy is a very important issue. The frauds has to be decreased. The digital ecosystem has to be protected. Another risk is climate change. Climate change based financial risk. So there are financial risks based on climate change. As the climate change is happening, if rain happens less, or if disaster happens, what's the problem? Why there is the financial risk with the climate change? Try to understand it. Try to understand that there are climate change related financial risk. Let's say that a disaster has happened. So many of the big businesses that were present in that area, or many of the small households that were present in that area, because of the floods or because of the earthquake, all these buildings are going down. All these businesses are going down. All these households are going down. Many of the households that had taken the home insurance, or that had taken the insurance against such natural disasters, so the insurance industry will feel the pressure from the entities, as well as many of these businesses that had taken loan from the banks. Now they will not be able to return the loan. Their whole system has been broken. So you can understand that if a disaster happens, that not only affects the people that are involved, but that also affects the whole of the financial system of the country, because the insurance industry, insurance sector, as well as the banking sector and the NBFCs, they also face the problem, because many of the people, they will not be able to return the loans that they had taken. The collateral, like many of the people that had kept their houses as collateral, house has been gone. So the whole collateral has been degraded, or it has been destroyed because of the disaster. So disaster, it affects the livelihoods of the people, it affects the house of the people, but it also lead to the financial risk. The last risk that we are going to talk about is the contagion risk. Let's say a bank has fallen down. A bank is facing the crisis, and now many of the insurance companies, many of the NBFCs that had invested in the bank, they will also face the problem. Okay, many of the mutual funds that had invested in the bank, they will also face the problem. The recent cases of IndusInd Bank, a small crisis, a small problem, because IndusInd Bank, if you see the financial situation, IndusInd Bank is fine. It has good LCR, it has good capital adequacy ratio. So IndusInd Bank has only faced an accounting problem, and because of that accounting problem, the whole share value of the IndusInd Bank has decreased. So how many of the mutual funds, how many of the NBFCs, how many of the other banks that had invested in this bank, they are facing the problem. So there is a contagion risk. Now this is a small problem in IndusInd Bank. What if a bank has a major problem and the bank is on the verge of failing? So the whole contagion problem will come into the other banks and NBFCs also. Okay. So in terms of emerging risk, cybersecurity, climate change and system-wide contagion need attention. These three problems need attention the most. Financial stability risk from climate change appear manageable but warrant careful monitoring. So right now we are able to manage the financial risk coming from climate change, but we have to keep focus on this. We have to keep knowledge about this. Okay. We have to continuously monitor it. The assessment suggested, the assessment, that is the financial system stability assessment report of the IMF, has suggested enhanced data coverage with greater level of detail of mapping climate related financial risk. So there is greater data coverage that is required. We need to collect the data so that in cases of disaster, we are able to handle the disaster in a faster manner, or at least we have the data for our country that where the disaster can occur. Okay. Next is IMF also analyzed cyber security framework in India. IMF has found that Indian authorities have advanced cyber security risk oversight, especially for banks. However, the IMF has said that the same measures that are being taken for the banks, the same measures has to be taken for the other entities also in the securities market, in the insurance sector and in the NBFCs also. IMF has stated that extensive cyber security crisis simulation and stress test for banks could be expanded for the other sectors also, and market-wide events to further strengthen the cybersecurity resilience. Okay, for banks right now the cybersecurity is very strong, and the RBI is having a strong oversight over the cybersecurity risk. But this same the simulation, the cybersecurity crisis simulation and the stress test that are being followed for the banks, they have to be followed for the other entities also. The recommendations in case of India financial sector assessment program are mainly focused on bringing about further improvement. So IMF has said that whatever you have done till now is very good, it is appreciable. So whatever recommendations IMF has provided, they are about further improvement in the structure of and functioning of the financial system, and many of the detailed recommendations are actually in consensus, in conformity, in line with the concerned authorities or regulators' own development plan. Like I have told you that the IRDI has actually in its annual report that was released a few months before. So IRDI itself has mentioned that we are thinking about transitioning towards the risk-based solvency ratio and towards the risk-based supervision framework. Now the IMF has recommended the same thing, that it has to be done faster. So you can understand that the regulators of our country, their vision for the future. So whatever improvements the IMF has said, it is in line with the vision of the regulators for the future. Okay. So the recommendations in case of India, they are mainly focused on bringing about further improvement in our financial sector, and many of the recommendations that are provided by the IMF, they are in line with the vision and development plans of the concerned authorities and regulators. India remains committed to adoption of internationally accepted standards and best practices in a phased manner. We are slowly trying to have the best practices at the international level or the internationally accepted standards attuned to domestic needs. If they are in the domestic needs, if they are as per the domestic requirements and economic conditions wherever necessary. So India remains committed to adopt the internationally accepted standards and best practices. Okay. So this is the idea. So now this is the first question. I hope you will be easily able to answer this question. And let me tell you that this is the first question that you have to answer. Okay. And this is an objective question. I hope you will be easily able to answer this question. The second question is this. This is the second question, that what are the key findings of the IMF's latest India FSSA report regarding the resilience and the evolution of India's financial sector, you have to provide the recommendations also. Okay. Now, as you know that Perspective 360-degree series is going on Monday, Wednesday and Friday 5 p.m. Okay, so Perspective 360-degree series is going on, taken by Jaskaran sir. If you want the answer writing practice, you can see the Perspective 360-degree series Monday, Wednesday and Friday, and your answer will not be evaluated in the Finance 360 series because this series is for Finance Current Affairs, but in Perspective 360-degree series, your answers also get evaluated, okay, by the additional team that we have. Okay. So yes, the press release I have brought for you, the whole press release. I have not left out any major point from the press release. So in the press release, there was no major data point, but the recommendations you have to keep in mind from the perspective of the IMF, and the question can come on the report because you know that the World Bank, WTO and the IMF's reports, direct questions have been seen from these reports in your previous examinations of RBI and NABARD. Okay, specifically this report is important from the RBI perspective. Okay. So this is the idea. As you know that the questions have come on migration, the questions have come on inequality, because these reports were released by the important authorities, by the important institutions. So you can understand that the FSSA report is released by, it is published by IMF. So this is a very, very important report that you cannot miss. And I tried to bring the important and all the points. Literally, I have not missed any point from the press release. I have not seen the report in the totality, but the press release, because I covered the RBI website and the Finance Current Affairs, so from the press release I have brought all the important points. Okay, and that is the mota thing that you need to understand. Okay, so this is it. Thank you very much for joining the session. Do give me the right answer of the homework session, and this is it. Thank you everyone. Thank you for joining, and if you have any query, you can comment down below. I hope you enjoyed the session. Let's meet in the next session. This session was a little complicated because the IMF has said a lot of difficult terminologies and different markets were involved, different terminologies were involved. So I tried to bring the definition of many of the statements or many of the terminologies, so that in the PPT, like when you download the PPT in the PDF format, you will get the definition that I have brought in the PPT. Okay, so this is it. Thank you everyone. I don't know about the next Thursday. Okay, next Thursday. Okay, sorry. If you are asking about the revision session, so I will be taking the revision session on next Thursday. Okay, 6 p.m. at 6 p.m. At 6 p.m. on Thursday, I will be taking your monthly revision session of the RBI website for your February 2025. Okay. So this is it. Thank you everyone. Thank you for joining. I hope you like the session. Do tell me in the comment section.